Okay, great. Let's get going. Welcome again, everyone, and thanks for joining me on this lovely Tuesday evening. We've had some thunderstorms in the area, which we don't get that often in the Southern Cape, but I always enjoy it when we do get it. So I'm just grateful that our internet survived it here where we are between the oceans and the mountains. When we have any kind of inclement weather, it's often a bit hit or miss as to whether we've got our internet up and running. It's either absolutely fantastic or it doesn't work at all, although most of the time it's absolutely fine. So anyway, here we are. So let's get going. Last week of the challenge, obviously, so great. Well done to all of you who've stayed the course. It's pretty tiring. I'm sure you'll agree with me when you have to do it like this, but it also gets you into the mode of what you have to do when you're a professional trader, which of course is what GoPro Trading Academy is all about. You know, we're not here just to teach people how to trade as a hobby. I personally don't believe that you can trade as a hobby as such, and that it's even advisable. It's something that you either do properly or not at all, simply because of the very real risks associated with trading. And you guys pretty much all know me well enough to know that I focus heavily on risk management in everything that I teach you. And that's because that's what I do. And that is also one of the main reasons for my ability to have survived as a professional trader, certainly as an independent professional trader now for 15 years, going well, even more. And in my trading career as a whole, including my institutional career, significantly more than that, it's always been a rigorous focus on risk management. I do also give credits to Lady Luck or to fate for my survival in some areas, but that also goes to show why trading casually is not advisable. And we're also here to help our members to become professional traders simply because most people who come to us at GoPro Trading Academy want to be professional traders. They want to take it seriously. They want to learn what they need to learn in order to be truly successful as a trader. And of course, that ultimately means that you need to get to the point of trading other people's money. If that's where the real money is. If you're going to do this properly, that's where the real money is taking a share of the profit that you make for somebody else. And that's something else, of course, that you guys by now probably know about, that we have been working on arranging for anybody in the academy who wants to take advantage of that is proper funding, proper funded accounts, fully transparent. But again, you know, you're trading someone else's money, your number one focus must be on risk, of course. So yeah, that's really what I just wanted to talk a little bit about again tonight. So we're not going to look at any charts. We're going to get a little bit more technical just for 20 minutes or so. If you do have any questions for me as well, based on the training that we've covered in the last while, please do pop that into the chat box. I can't promise that I'll be able to cover it this evening, but I certainly will make sure that I do cover it in the next few days. And in fact, that's what I'm looking to do still this week, is have another training session for you folks, which is focused exclusively on answering your questions. So please do send those through to me or to Corrine so that we can assimilate those and I can make sure that I cover all of them. All right, so what are we looking at here? Most of you who've done my training know exactly what this is all about. Basic spreadsheet, obviously, but what it is effectively is a probabilistic P&L. And when I first put this together, it helped me to connect the mindset side of trading with the practical side of trading. So, you know, the consistent application of a rule set or strategy to appropriate market conditions is the practical side, the technical side. But on the there's a huge gulf between that and being able to maintain the probabilistic mindset, which is so essential to being successful as a trader. And that's what we use this probabilistic P&L for. So I'm just going to talk through it briefly again this evening. We can spend some more time on this in the future as well. but I just want to make sure that everybody is on the same page with me here. So there are basically four key numbers that that really apply to everything in existence, to be honest with you, but are certainly pretty blatant in trading. So I just want to make sure I put that up there as well. And I'm just going to take the default starting position that we risk 1% per trade. That is a reflection of how much you are using the leverage that your broker offers you. It's not specifically a measure of the leverage. It is a relative measure. So if you are risking 2% per trade, that means you are using double the amount of leverage that you would be using if you were risking 1% per trade. So it's not specifically a measure of leverage, but you can see that as a scale of leverage, it does apply. We then have this metric called success ratio. So you will recognize, of course, that I use maybe in some cases slightly different terminology from what is commonly seen out there in the amateur markets on the internet. But you know, if you want to look at this as a professional, this is how you do need to look at it. So success ratio is pretty much what it sounds like, where we're looking at the ratio of winners to losers. And this is where most amateur traders apply most of their effort. You know, most people who come into trading believe that really good traders are good at finding winning trades. It's an absolute fallacy. It's completely incorrect. You know, if you take that to its logical conclusion, it means that you believe that a professional trader is able to forecast the future. It means that they are able to see if a particular trade is going to win or lose so that they can avoid taking those trades that are going to lose and only take those trades that are going to win. That's what most people believe. And I'm sure if you're honest, you will agree with me. That's what you believe when you got into trading. Maybe you still believe that. And if you do, I'd really like to disabuse you of that notion because it's absolutely false. And it kind of assumes that professional traders have found some kind of crystal ball. And we actually call that the crystal ball syndrome when people believe that. It's completely untrue. And yet for people who haven't actually understood what trading is actually all about yet, they don't see any way around that. I mean, how is it even possible then to be profitable if that's not what you are doing? So it's the logical conclusion that a good trader is somebody who's able to avoid losing trades and find winning trades and thereby be profitable. That's the logical conclusion. Now, that is absolutely incorrect for truly professional traders. Any professional trader knows very clearly that it's impossible to forecast or predict anything that's meaningful in the market. So that where does that leave us then? Well, it leaves us with two things. First of all, it leaves us with an understanding that the human mindset has a significant weakness when it comes to trading in particular. It's a great strength, and obviously I belabor this point in our more detailed trading on developing a robust trader's mindset, but it just illustrates the fact that the human mindset, and we all have one being human beings, unless you come from some other part of space, but I recognize everyone here, so I don't think so. We are all human beings, and therefore we all possess this thing called a human brain, and therefore a human mindset. The human mindset is designed by whoever, God, whatever, to be a predictive engine. That's exactly what it is. It's hardwired to be a predictive engine. Now, that is great for most things. Certainly, if you look at the success of our species, and I use that word in very much in inverted commas, then you know it's all about being able to find ways to avoid negative outcomes and ensure positive outcomes, which is kind of the same thing. Avoid losing trades and find winning trades and only take winning trades. We've gotten very good at that. But the human brain is designed to do that. And we have a couple of ways of doing that. And again, I won't belabor the point. The one is we look for systems that repeat themselves reliably. And then we also use our natural abilities to create an environment which is predictable. So that, I'm sitting indoors, I can say that if it starts raining again, I can predict that I will stay dry. As one simple example. So we are able to use our natural abilities to control the environment so that we can predict. Or else we find naturally repeating, reliably repeating systems, again, so that we can predict. And those are the two things that we have harnessed in order to be as successful as we are as a species. But when you're faced with an environment where neither of those two things is possible, neither of those, you cannot find, there is no such thing as a reliably repeating cycle. And a lot of people fool themselves about in the markets about that. All reversion to the mean strategies depend on that, and they all work well until they don't, which is when you blow your account. And of course, you cannot manipulate the environment or control the environment in any way, shape, or form in trading so as to engineer a favorable outcome and prevent an unfavorable one. So where does that leave us? Well, it leaves us with a problem. It leaves us with an understanding that this thing of success ratio that we focus on so much is in fact not as important as we think it is. And we need to recognize that by focusing on that, we are ensuring our eventual downfall as traders, not in the short term. Of all the people who try trading, a good 20 out of 100 will learn how to make money. But of those 20, only 1 or 2 will ultimately get to keep it. And the other 18 or 19 will still lose all their money. And those are the guys who lose the most and cause the greatest catastrophes in the market as well, as we've seen, as history has shown us. So what else is there? Well, it's the other side of that coin, which is the reward to risk ratio. So, if we assume that we, let's say, have a 60% success rate, that means our ratio is 60-40, which is 1.5 to 1, with a reward to risk ratio, let's say of 1 to 1, then it means that for us to be profitable over here, we absolutely must win more trades than what we lose. So we have to find a way to avoid losing trades as much as possible and to ensure that we have winning trades, which leaves us with an expectancy, as you guys will remember, of 1.5 to 1. Well, what does that mean? It simply means that for every dollar you lose, you make $1.50, which is great, you will argue, and certainly on the surface of things it is. And let's say, for every 100 trades that you take, that means of that 100 trades, I'm just going to do the maths with you here so that if you ever want to recreate this, you can. So we take those 100 trades. Well, we know that the proportion of those is, let me say 1.5 divided by that plus 1. It's been a while since I've done, so let's hope that it works out. Yes, that means if obviously 60% success rate out of 100 trades, we'd expect to win 60. We'd also then understand that the balance were going to be losers, which is 40. Now, the question then is, how much money did we make? Well, it's pretty simple over here. So the net is going to be our 60 winners multiplied by how much we make when we win, minus our 40 losers, multiplied again by how much in this case we lose when we lose. Now, we're assuming 1%. And what I should actually do here is use that at the top there, but I'm just going to leave this. We're not going to change that. Just remember, we assume that we are risking 1% per trade, and that is what that means up there. All right, so that means that ignoring any kind of leverage, we've netted 20% on this. But now the question that I have for you is, what if we actually had this the other way around? What if we only won 40 trades, which would imply what's that, 40 over 60, so it's 0.67, let's call it, to 1 ratio. 0.67 to 1 is a 40-60 success rate as a ratio. Then, how are we possibly ever, how is it possible for us to ever make money? And of course, the simple answer is, once you understand that there are 2 components to our expectancy here as well, if we were winning enough on our winners and ensuring that we were not losing nearly as much on our losers, then fair enough, we could be profitable. And in fact, what if Our winners were, let's say, 50% more than our losers. So our reward to risk ratio would be 1.5 to 1. Well, obviously, I need to change this slightly. Let me just make this 2. Let's make this 2 to 1, shall we? So just to keep the maths the same. So if we were to then, I'm not even getting that right. Let me make this slightly bigger. I just want to get that bottom line ratio pretty much the same, just as an illustration. 2.25, somewhere around there. Getting pretty close. I don't waste our time over here. Okay, 2.2. Let's go back to that. All right, so almost identical. Where in this case we've got a 40-60 success ratio. We are effectively, if we take the same 100 trades, but let's say we just pushed our take profits a little bit further away or brought our stops closer in, then clearly you could see that I've made a mistake over here once again. 0.6721. I took the easy way out. But nevertheless, if we were to actually let's make this a little bit easier and make this let's say a 50-50 scenario where we win half of the trades. And I'm sure you'd agree with me. Most people would say, well, what's the point? It's like playing with dice. I mean, with a coin, heads or tails. What's the point? Well, the point over here is that our winners are bigger than our losers. How many of those would we win? Well, it's definitely not going to be that. So let's just have a quick look. Nope. So clearly, if we take 100 trades and our success ratio is 1 to 1, it means that we are going to win 50 and we're going to lose 50. So I'm not going to worry too much about that. But if I do copy this across now, you should see that in actual fact, we are still making money, aren't we? Because our 50 winners, if you look at those 50 winners have netted us 1.5% on each of them, whereas the 50 losers have only lost us 1% on each of them. So 50 winners times 1.5 is 75% gross winnings. And the 50 losses, those that we lost, we've actually only lost 50, netting us 25%, which you will notice is in fact more than what we were making with the same expectancy, because for every dollar we lose, we make $1.50. This is actually making us more money when we lose more trades, even for the same expectancy. This goes completely against the grain for most human thinking. For most people, when they first see this, they can't really believe it. It doesn't seem to make sense. How is it possible to have the same expectancy? For every dollar we lose, we make $1.50. Makes no difference. How is it possible that when we lose more trades, we make more money? It sounds absolutely absurd. And this is one of the most important lessons that I actually have for you folks. Because your natural instinct, if you've got 100 trades, and let's say you've won 60 and you've lost 40 and you've made 20%, your natural instinct is going to say, well, how can I find a way to win more trades and to lose fewer trades? That would be the natural instinct. And you know what? You can. You absolutely can. Now, if you, assuming that you don't do something completely stupid, such as adding to losing positions and things like that, martingale approach and so on, which ultimately will definitely help you to blow your account. I'm assuming that you won't do anything like that, but let's say you do something quite simple, which is to say, well, we did win those 60 trades, but quite a few of the losers did go into a profit. They got even like halfway to the take profit before in fact turning around and coming down and stopping us out. So, why don't we, and by the way, there were also a few trades that, that could have been, that they got, that if our stop was a bit further away, wouldn't actually have stopped us out, because I'm sure you guys have all experienced this where, a trade just gets stopped out and then it turns around and goes on and hits where your take profit was. So you see that and you say to yourself, well, if I just had my stop a little bit further away and my take profit a little bit closer, I would have had a lot more winners out of those 100 trades. So what you instinctively look to do then is say, well, what if I, brought the take profit a bit closer and moved the stop a bit further away? I would have had 75 winners and only 25 losers, which means that you now have a 3-to-1 success ratio, 75 over 25. That's your success ratio. But you do know that you have moved your take profit closer and you have moved your stop away, so much so that the distance to your take profit is approximately half of the distance to your stop. So that gives us a reward to risk ratio of 0.5 to 1. I'm sure you guys can all follow that, which again means that our expectancy is still 1.5 to 1. So for every dollar we lose, we make $1.50. But you feel better because you've won 3/4 of your trades and you've only lost 1/4 of those trades. But the question now is, what do you net? Well, let's look at this, because if you, I'm just going to work it out with you. Let's do the maths. If you take our winners, 75 of them, but you multiply that by how much percentage-wise you actually won to give you your gross winnings, and then you subtract the total number of losers multiplied by how much you lost, which was the full 1% when you lost those trades, you find that you've only netted 12.5% profit. It's the same principle. You can see that over here, by losing more trades, but following a more probabilistically robust approach to the market without pretending that there's any effective way of predicting anything meaningful in the market, you actually made more money despite having more losers and with the same expectancy. And here you found a way, and that's one way. There is another way as well with filters and so on. You found a way to avoid more losers and actually harvest more winners. But by doing what you had to do to get that, you end up making less money. What actually happens here ultimately, if you take this to its logical conclusion, and you absolutely can, is you will become frustrated at how little money you've made, because what this is ignoring as well, folks, is things like spreads and other trading costs, like the hidden trading costs like slippage and your swaps. It gets increasingly difficult to cover those other costs with the amount of profit that you're making on your trading. So you will find yourself trading furiously, and after 100 trades, you won't even have made half of that because of the other costs. You won't even have made 5% after 100 trades. That is very frustrating, and you will subsequently do exactly what everybody else does when they are facing this situation, which is to start upping that number. You will start using more and more leverage in order to make the required amount of money from your trading. And that ultimately means that your trading approach has become more and more fragile. And what happens when something's fragile? The enemy of anything fragile is time. In time, sooner or later, something will happen to blow your account. It'll blow you up. And that, folks, is what happens to the 18 or 19 people who learn how to make money in trading, but don't get to keep it. The 1 or 2% who do become successful long-term and who not only learn how to make money, but learn how to keep it, are the ones who learn how to move in the right direction, literally and figuratively, moving to the right-hand side. So even keeping a pathetic expectancy of 1.5 to 1, but that's actually enough. Let's take this even further, shall we? Let's look at the opposite scenario of what we were trying to do there. So in this case, we are saying that we are only going to be winning 1/3 of our trades. So out of 100 trades, we only expect to win, let's say, 33. I'm going to round it down, yeah? And we are in fact going to lose 67. Now, to the amateur who comes into trading, this is just ludicrous. Well, why would you possibly ever want to do this? It makes no sense whatsoever. And certainly, as I mentioned to many of you on our courses beforehand, if I went into a course and told you that I lost 2 trades for every winner, you'd chase me out of the room and you wouldn't want to listen to me any further. However, this is precisely what the most successful traders of all time have consistently done, is they have lost more trades than what they've won. And all they've done is found ways to maximize the reward to risk ratio whilst making sure that the success ratio is still somewhat under control. I've spoken many times about the extreme of this, which is Nassim Taleb. Hopefully you guys have all gotten read his books, including Fooled by Randomness, and you'll remember how he talks about how the one strategy that they used for out of the money options, they would win only 1 out of 20 trades, which means that that was a 1 to 19 ratio, 19 losers for every winner. But the average winner was 50 times as big on average than the average loser. So if you do the maths on that, you'll realize that that's extremely profitable. The problem with us, again, is that we have this predictive brain, this predictive mindset, this predictive engine. And it is so difficult unless you continually educate yourself and focus on this truth. And this is truth that exists outside of the human species, folks. This is what I call the dark side of the moon. This is truth that the universe runs on. Okay, it is something that is way beyond us as a species. So what you need to recognize in all of this is that you've got to train your brain continually and consistently to accept losers as if they're unimportant and welcome them in fact as the price that you need to pay in order to position yourself to gain the winners. I often say to people as well, the difference between an amateur trader and a professional is that the amateur is focused on avoiding losers, whereas the professional is focused on ensuring that they don't miss the winners. And if you've got a 3-to-1 reward to risk ratio or more, excuse me, of course, that's what you're going to be doing. You're going to ensure that you take every trade because you know that you can't afford to miss the winners. What makes it increasingly difficult as well, or even more difficult, is the fact that with this type of approach, we become less and less able to say when the money is going to come, when the profits are going to come, because you don't just have 1 winner, 2 losers, 1 winner, 2 losers. We have strings of losers and small clumps of winners now and again. And that can be very painful, very painful. It's like Chinese water torture, but it's absolutely essential that you learn how to do that. Because if you then do the maths, let's see if this works for us. Yes, it does. If you then do the maths, even though you've lost 67 of these 100 trades, of those, and we're just assuming that you've lost 1% on all of those, you lost 67. But of your 33 winners, you made 3% on each of those, which would be 99. And 99 minus 67 is 32. Now, of these 4 scenarios, which is the best? Which is the one that you prefer? And clearly, it would be this one. Now, when we talk about our advanced trading strategies, like the impulse strategies, they all focus on the right-hand side of the scale, all of them. That's what makes them professional strategies by nature. Not because they're very difficult from a technical perspective, and they're sure, I mean, if you want to learn how to trade properly, you do need to learn how to do multi-time frame analysis. But you guys, most of you have got that. If you've done the free training on the daily impulse strategy, you will have seen how to do that. You do your higher time frame analysis on the weekly time frame, and you drop down to daily for your final criteria, selection criteria, and your execution. And from your execution, obviously, we go into trade management and so on. But that's what we do. That's the technical side. But what makes these strategies difficult is this stuff. It's the fact that you can't know when the next winner is coming, especially if you're using advanced targeting. If you're using advanced targeting, which we cover in detail in the course, or in the courses in the academy, then you will always find it even more difficult to know when the next winner is going to come. You will see many trades go well into profit and then end up not being profitable. Certainly with advanced targeting, as I'm sure many of you have seen. But when you do win, when you do make money, you make a lot. you make way more money on your real winners than anyone who is using a more predictive approach, which is much more fragile and is represented on the left-hand side of the scale. So I encourage you guys always to think about this. It's such a simple little bit of maths that we're doing here. My accounting background way back in the 1990s gives me away when I talk about a probabilistic P&L, profit and loss account. But that's pretty much what it is. There is a little bit more to this as well. What this doesn't show is the risk side fully. It shows some of the risk side, but it doesn't represent all of that, because we haven't actually shown here that you can use a lower risk level as well in order to produce similar results. So that's something that we will leave for another time. For now, really, the number one thing that you can do for yourself, if you haven't done so already, is to get your head around this. Get yourself thinking about why it is that you make more money even though you've had a higher proportion of losing trades. Why is it desirable to have a higher proportion of losing trades? It sounds absolutely absurd to somebody who hasn't got their head around this stuff. And yet, for you to be successful long-term as a professional trader, for you to be able to be consciously competent when you take over a funded account, when you start trading somebody else's money, you really need to have your mind fully wrapped around this stuff. It is the number one thing that prevents, I believe, that prevents people from being successful as traders. All right, so folks, I just wanted to cover this in our last week now. I know many of you have heard me preach this many times in the past, and I'm sure you'll agree with me. The message hasn't changed at all, but it is so important that you get to grips with this. It doesn't happen overnight either. It's one thing to understand it at an intellectual level. In the beginning, it's quite mind-blowing, but once you understand it, even then, that's not enough. Because the reality of trading, and as Muna says, especially with advanced targeting, it requires a mind of steel. Unfortunately, there's a lot of truth to that. But this is why so few people survive as traders, because they're not prepared to do the work to develop that kind of a mindset. They're not prepared to put that in, to develop a probabilistic mindset, one where, look, you're still a human being. You're still going to feel it. Trust me. Okay. After 30 years of trading in different forms, I can't say that I'm immune to that either. But I understand myself. I understand how my mind works. And I have ways of dealing with that. And you will learn that too. But you cannot develop a probabilistic mindset, one which allows you to trade these strategies consistently unless you're aware of this. All right, folks, so I see you haven't actually popped in any questions for me while we've been chatting about this. So if you do, please do drop in some questions for us. In fact, I'd really suggest that you send us a message at support@gptacademy.com. Most of you, I'm sure, have got that. For anyone who's listening to this as a recording, you can also send us a message at GoPro Trading. I'm sure Corinne will be all over that. And any topics that you want me to cover and revise in the next week or so, I'd be happy to do that for you. Then what we're going to be doing as well is over the weekend and to early next week, we'll be going through all the trading statements and looking to find our winner for the 2020 GoPro Trading Academy Trading Challenge. So that we will be doing. We will announce the time when we're going to tell you who the winner is sometime next week. So do keep an eye open for that as well. I'm sure you guys have all got the GoPro Trading group, all of the notifications popping up. So please make sure that you do, otherwise you might miss that. And we're also going to show anyone who's not been able to take advantage of our training, how they can get access to that as well, which also will allow you to get access to funded accounts all the way up to $2 million. So if that doesn't excite you, I'm not sure what will. All right, so that's it from me, folks. Thanks very much for joining me this evening, and I look forward to chatting to you all again later in the week. Bye for now.